All right, digging a little bit deeper into the reflation trade. Reopening ETFs, they're red hot again, powered by renewed flows into travel and leisure ETFs. This month, as COVID restrictions ease all across the globe, that reopening narrative is beginning to really regain some steam. Airline ETFs, hotel ETFs, and leisure and entertainment names like Invesco Dynamic Leisure and entertainment ETF ticker PEJ, they've all led the charge higher, up 5 to 10% just over the past week. And as rates rise, investors are offloading broad swaths of bond ETFs here in the U.S., but the global fixed income is getting just a bit more of a bid. Tom, back over to you again. What are the flows telling us about how investors are really feeling right now? Is it finally the cyclicals time to shine?
Yeah, you're right on the reflation trade. As things start to warm up, people are mandated less to wear masks. That's really good. It's very optimistic. But at the same time, what we're seeing is diversification. It's nice to pick up some of these thematic strategies, like I say, PEJ, or the airlines ETF, JETS, JETS. But I think the key thing here is it's diversification. As you point out with fixed income, we're seeing rising interest rates and the threat of rising interest rates here in the U.S., Frank. But overseas, not all developed countries are suffering from that threat of rising rates. So people are diversifying to areas like emerging markets, where it's not only an opportunity to get a better yield, and you're also not going to be threatened by central banks necessarily being as hawkish as we are here in the U.S. Also, there's a currency play here. If we're in a situation where some of these foreign currencies may actually do better than the U.S. dollar, there's another form of diversification.
Yeah, certainly. John, over to you. You run the Astoria inflation-sensitive ETF. The ticker is PPI. That's up nearly 6% year to date. Tell us what you're seeing here.
So about 2 years ago, I actually came on ETF Edge in June of 2020. And at that point in time, the 10-year was at 30 basis points. There was a ton of liquidity being provided to the market. I know from the data and the evidence and history of managing money that, typically after a recession, you get this wave higher in value, cyclicals, inflation-sensitive stocks. So, about a year and a half ago, we put together a formal inflation-sensitive model portfolio. It's basically 10 instruments to kind of try and hedge against inflation, banks, energies, industrials. A couple months ago, we went ahead and launched a formal ETF. So ticker PPI, which is a play in the producer price index, it gives you exposure to banks, energy, industrial, materials, those four sectors. The data shows that historically those four sectors do the best when you have rising inflation. We do also add commodities in there. We like commodities, as we just talked about, and all the attributes that they provide. What I would say is that, Tom mentioned he surveys advisors. We serve as an outsourced CIO for other financial advisors. We actually have the evidence. We see these portfolios, on the margin. Yes, are they tilting more towards, commodities and things like tips? Yes, but the lion's share of the money is still in very deflationary sectors, and still a lot of growth bias, a lot of technology bias. So we kind of have been saying add 5-10% of your portfolio towards inflationary type ETFs. Obviously we like our ticker, but there's other instruments out there. What I would say is that from 1989 to 2000, you had this big bull market in growth stocks. And then after the dot-com bubble, you had a 7-year run where value stocks outperformed. Then from the great financial crisis till about 2020, you had, a massive run in growth stocks. I think this value cyclical inflation trade is still in the early stages. If I'm a financial advisor, I would really be looking at your portfolio and say, what can you do on the margin to hedge against inflation? CPI is, 7%. When I look around the world, I see inflation more like 15%, even higher, when I look at costs of goods and, grocery shop and home prices. So I would really start to be more active in your portfolio.
Yeah. And Frank, one thing just to add on really quick. A lot of folks feel that a way to protect yourself is via gold. Gold traditionally has been a great protector against inflation, but it's been one of the worst performing commodities during this inflationary period. So as John's pointing out, it's important to be diversified among a whole basket of different commodities, and they've done that in their ETF PPI.
Yeah, really interesting stuff, guys. There, obviously, inflation having a big impact on the markets and your investment strategy overall.